Hello, everyone. Thank you for being here today. Excited to talk to you guys. Today, we're diving into a topic that can have a real financial impact for anyone who files taxes, which is everybody, or everyone should file taxes at least. What we'll be talking about today is the difference between tax deductions and tax credits. Many of you have heard these terms before. Sometimes they're used interchangeably. That's not necessarily correct. A lot of people may not fully understand how they work, how much they actually impact their taxes, what kind of savings are associated with it. So I want to just jump into why is this important. This knowledge genuinely can, if people use deductions and credits strategically, use them properly, try to maximize them, can end up saving at times thousands of dollars, which is a pretty big deal. Most of us, myself included, would not be mad at an extra $1,000 in my pocket. Let's walk through each one, how they differ, and how we can maximize them when filing to save the most on our taxes as possible. The first one I wanted to start with is tax deductions. Deductions reduce your taxable income, so it's the amount that your tax is calculated on. If you have a job, you have income, say you make $90,000 in a year, you may not have to pay tax on that full $90,000. It's tax deductions that reduce that. Sometimes these deductions show up automatically on your W-2. I'll show an example for that. The most common ways to reduce that is through your HSA or through 401k contributions. This reduces your taxable income before even taxes come into play, before the number we put on the tax form. And then besides the W-2 deductions, there's two types of deductions we see. There's above the line deductions, which just show up on a specific place on the tax form. I'll point that out to you later. These include student loan interest, traditional IRA contributions. If we make HSA contributions outside of payroll, so you call up your HSA company to make a contribution, that would also be an above the line deduction. The other is below the line deduction, and this is either your standard deduction or itemized deductions, which with standard and itemized deductions, a standard deduction is a fixed amount the IRS gives everybody based off how they file, whether it's single, head of household, married, filing jointly, and it's fixed. It doesn't change based off anything other than your filing status. Itemized deductions can change based off our real actual expenses. The four most common itemized deductions is mortgage interest, property tax, charitable contributions, and then state taxes we pay. So our withholdings for state tax through our W-2. Some states allow you to deduct car registration if there's a tax specific to that. But if all of those add up together to be higher than the standard deduction, then you itemize instead of taking the standard deduction. This last year for married couples, so in 2024, the standard deduction was $29,200. So if we wanted to itemize, all of our expenses would need to be higher than $29,200, or it wouldn't make sense for us to itemize. We'd end up losing money. The next thing we want to look at is this W-2, like I mentioned, that we can have deductions come through on the W-2. In box 1, there's the wages. So this is the amount that is put on our tax form. In box 3, there's the Social Security wages, which is about $10,000 higher. So the difference between those is this 401k contributions, there's $5,000 here, and HSA contributions, there's $5,000 here. So together, that's the $10,000 that reduces your taxable income on your W-2. So now let's jump into tax credits. Credits can sometimes be more valuable than deductions, or are considered more valuable than deductions at times, because this doesn't reduce your income, this reduces the amount of tax you actually have to pay. So after the deductions are calculated, you'll have your tax that you owe for the year, and your credits will then come in and will reduce any tax that you owe dollar for dollar. There's two types. There's refundable and there's non-refundable credits. The most common refundable credits are there's the earned income tax credit and the child tax credit. That's for kids 16 years and younger. You get $2,000 currently, 17 and older, only $500. Then there's the American Opportunity Credit. That's an education credit. And then some of the most common non-refundable credits are the Lifetime Learning Credit Any energy credits, whether that's solar, maybe you replaced exterior doors that are energy efficient, replace your windows, more an efficient water heater, heat pump, etc., etc. So any energy improvements to our home there. And there's also the Savers Credit, which is a credit for making contributions to retirement through an IRA or similar to there. The big difference between refundable credits and non-refundable credits. Non-refundable credits, all they can do is wipe out tax you owe. So say you owed $2,000 in tax and you had $3,000 of non-refundable credits. You don't get that extra $1,000 back. It's just going to show you owe $0 in tax. With refundable credits, anything above the tax you owe, you actually can get as a refund. So if you get, say, $2,000 from the child tax credit, and you only owe $1,000 for tax, the IRS is going to pay you that additional $1,000 and send you a refund for that amount. So it's pretty straightforward. Refundable can result in a refund. Non-refundable, unfortunately, cannot. They just take care of tax liability. So let's look at a real example. In this case, we have Mr. Tax Deduction and Mrs. Tax Credit. They're married, they're filing jointly, and together they earn $90,000 in a year. So let's take a look at some of the deductions that they are claiming for the year. So they contributed $5,000 through his W-2 towards an HSA, so that's going to reduce that by $5,000. Besides that, they also made an additional $3,500 contribution to their HSA. They contributed $5,000 to a 401k. They paid $1,000 towards student loan interest, and he did not have the option 401k, so he also made a $2,000 IRA contribution for the year. They had $33,000 in itemized deductions. And then now let's take a look at the credits. So they have one kid between them, so they're going to get $2,000 for that child tax credit, and because of the IRA contribution, they also will get $400 for the Savers Credit for contributing to a retirement account. So let's look at what this looks like on an actual tax form. So here is their tax form for the year. You see the child on here, and if you remember, they made $90,000 for the year, but you see they're only reporting $80,000 of income. This is because they get to reduce their income by the $5,000 that was contributed to the HSA and the $5,000 for the 401k. So we're showing $10,000 less of income on our tax form than what they actually made in the year. Then if we keep looking down here, line 10, this is their above the line deductions. So this is the sum of their IRA contribution they made, $2,000, $1,000 they paid towards student loan interest, and then they made an additional $3,500 contribution to their HSA outside of their employer. So all of that adds up to be the $6,500 deduction that further reduces their income. Then the next line down, line 12, this is their itemized deductions. So between state tax they paid, mortgage interest, and property tax, they ended up being more than the standard deduction of $29,200. So they'll take those itemized deductions and reduce their income by $33,000. So we started with $90,000, but our taxable income, so what the actual tax is going to be calculated on, is only $40,500. So you can see it's a pretty drastic difference for the amount they're paying tax on than what we started with. So you can see where deductions can really help lower how much income we're showing. So if we scroll down to our tax here, $4,399, this is our tax liability for the year. So this is the total tax that we owe for the year. And line 19 here, this is the child tax credit, which is a refundable credit. Unfortunately, they owe too much tax, so they won't be getting a refund here. And this $400 is the Savers Credit for the IRA contribution. So together they had $2,400 in credits that will reduce the tax they owe down to $1,999. So this is just a simple example of how deductions and credits both work together to lower the amount that we're ultimately going to pay in tax at the end of the day. Had they paid income tax throughout the year and say they had paid $4,000 towards it, they would be expecting a pretty decent refund because the credits help and they get the money they paid to the IRS back. So just to summarize what we talked about today, deductions, they reduce our taxable income, so they lower the amount we're going to pay tax on. So in the example we looked at, they made $90,000, but they only were taxed on $40,000 of it. One of the most common things you have to look at with taxes is if you're going to take the standard deduction or itemized, and you only itemize if your itemized deductions are higher than the standard. One quick note, for anyone that's married filing separately, they have to make a choice to choose to do the same thing. So one spouse can't file with the standard deduction and one spouse can't file itemized. Both spouses, when filing separately, both need to take the standard deduction or both need to itemize, just a note. Credits, they reduce your tax liability directly, so after your tax is calculated, it can reduce the amount of tax you have to pay dollar for dollar. Refundable credits can result in a refund. Non-refundable only can reduce your tax bill to zero. One last thing to note is the IRS loves to change these every year. So the type of deduction and credits you can claim, the amounts, there's sometimes income thresholds that if you make too much money, you may not be eligible for certain deductions or credits. These things change every year. So there's always value if you have any questions to go talk to a tax professional as they familiarize themselves with the new changes every year to make sure that people are claiming the proper deductions and the proper credits. But that's everything I wanted to talk about today. Thank you so much for taking the time to listen. I hope you learned something new, something exciting. Everybody loves taxes. If there are any additional questions, call your nearest Pack Tax location and we would be happy to answer any questions you have. Take care.